So for you, Bitcoin going from 126 down to 60K is not a bear market.
No.
It's a nasty correction.
It's a nasty correction in a bull market. Now, I've been in crypto since 2013. I've seen many corrections, non-bear markets, of 50% in Bitcoin. But people forget this every time. And when that happens to Bitcoin, others go down more. We've talked about this in the past. There's a risk curve. It's natural. Happens all the time. I think it was Solana last cycle did down 80 in 2021 before it had that massive run. And that was in a bull market year with liquidity flowing. Happens all the time. Happened to Ethereum. So it happens all the time.
The crypto market has gone from optimism to outright panic in a matter of days. Bitcoin has now crashed roughly 18% in just 4 days, plunging to a 4-month low near $60,500 and wiping hundreds of billions of dollars from the digital asset market. More than $1 billion worth of leveraged long positions have been liquidated in just 24 hours, forcing traders out of the market as selling pressure continues to build. Ethereum has suffered even more, falling below $1,700 and posting losses approaching 20% over the past week, while major altcoins like Solana and XRP have also been hit hard as investors rush to reduce risk. What makes this correction particularly unsettling is that the market is now approaching a level many analysts consider critical. Bitcoin is fighting to hold its 200-week moving average near the $61,000 region, a level that historically marked major bottoms during some of the most important crashes in crypto history, including the aftermath of Mt. Gox, the 2018 bear market, the COVID panic, and the collapse of FTX. If that support fails, some analysts are already warning that Bitcoin could revisit the $53,000 area, while others are watching the psychologically important $50,000 level. At a time when fear is spreading rapidly across social media, many investors are asking the same question: is this simply another correction, or is something much bigger unfolding? Yet while traders are focused on every candle, every liquidation, and every headline, Raoul believes most investors are looking at the market completely the wrong way. In a recent discussion, he explained why some of the wealthiest participants in crypto have succeeded not because they mastered every market cycle, but because they learned when to ignore the noise. More importantly, he reveals a strategy that he believes has consistently outperformed most active traders, even during brutal drawdowns exactly like the one we're experiencing today. If you're feeling frustrated, worried, or uncertain about where the crypto market goes next, then this is a conversation you need to hear. Powell's message isn't just about surviving this correction, it's about understanding how to position yourself for what he believes could be one of the biggest technological and financial shifts of our lifetime. Before we get started, please take a moment to like this video, subscribe to the channel, and share it with someone navigating this volatile market. And be sure to leave a comment below. Are you buying this dip, holding through the volatility, or waiting for lower prices? I genuinely love to hear your strategy and your thoughts on Raoul Pal's approach.
Is Bitcoin a proxy for AI as a trade?
Yes and no. I mean, because Bitcoin is going after global savings, but global savings should go up if AI changes economic growth. So therefore, that increases the eventual outcomes for Bitcoin itself. I think that there will be enormous amounts of liquidity from the private sector coming from debt that's going to feed this cycle. And that liquidity is debasement of currency over time. So that's good for Bitcoin. Mm-hmm. And Bitcoin is a digital store of value. And we're creating an increasingly digital world with digital intelligence. So yeah, it's fine. I think the layer 1 smart contracts are a better bet on all of this. They just don't feel like it yet to people. And the market can only have so much focus at once. And we've seen this before in crypto bull runs. It focuses on 3 things and it can't see the rest and everything pauses for a bit. And then it rotates to the next one because the market only has so much attention, so much capital at any one time.
You said everyone is so focused on the crypto cycles when the big picture is so obvious. You would never sell if you don't have to.
Yeah. I've obviously known this for a long time, but I'm just realizing now with the agents and the fun, with all of the things we've talked about, the endless debasement of currency, plus the agents, plus everything going on chain, it's like, why would you sell this? And I know people, it's hard for everybody. It's hard. But really, if you logically think about it, we know where the world is going. We kind of know where the market cap is going to be over time because it's following Metcalfe's law, and you can just draw the log regression channel. So why would you ever sell it?
Yeah, never sell and buy every month. I mean, at some point you get back to like the very basics after so many years, which is just never sell and just buy every month.
So it's the left curve and right curve is here, right? Yeah. And as I said, I mean, this is humanity's pension plan. This is what this is now, because we get to invest in the infrastructure rails of which all the agentic economy will run. We get to do that. It's a pension plan. It'll bail you out of everything that's happening. You just have to do it, which is why, I first said the economic singularity is coming, and you've got, at the time, 6 years. And now it's, 4 years away. You've got 4 years to just own as much of this shit as possible before you go into the biggest moments of uncertainty. But I think blockchain survived through the other side. Corporations, I have no idea what's going to happen over time. But blockchains, oh yeah. So I have done the work because I've been building an indicator for Real Vision to help people with this. And what I basically said is, if it's 2 standard deviations oversold on that log regression channel, between 1 and 2, you buy. It compounds at a stupid rate. Now, if you sell, how much do you sell at the top of the cycle? Here's the problem. Or how much do you reinvest back in the bottom? That's the hard part. Let's say you get 1-2 opportunities to add every 4 years. Maybe 1 in the middle cycle, 1 at the end of the cycle. You got 2 opportunities. You just save up money between each one of those. Do nothing, do nothing, do nothing. You get that, like we've just had, you buy. You go away, you keep saving money, you do that again. Okay, that's doable for most people. Keep adding to your bet as much as you can. That obviously outperforms everything because you never sell. If you sell at 2 standard deviations, how much do you sell? Or 1 standard deviation overbought? 2 gives you the least signals, but it's a better quality signal. And this is where the problem is. If you take 25% off, yes, you've got lifestyle chips, but then you've got less money in the casino. If you take 50% off and you say, well, I'm going to add that back at the bottom, good luck doing that.
Good luck.
Because people can't do it. We're seeing it now.
Yeah, it's too difficult.
People can't do it. They're doing it now and they're chasing it all the way up. Yeah. And you tend to it up. So on paper, you could be an absolute amazing compound performer if you could buy the bottoms and sell the tops. I've been in the industry for 35 years and I don't know anybody who can do it.
Every cycle, people make money in crypto. Every cycle, people lose it to hacks, exchange collapses, and compromised accounts. iTrustCapital's premium custody fixes that. It's a closed-loop system. Crypto goes in, but withdrawals only come out as USD to your verified bank. Nobody can drain your wallet because there's no external wallet to drain. Assets are held 1-to-1, off-balance sheet, with full tax reporting. And inside an iTrust IRA, gains can grow tax-deferred, or tax-free in a Roth. Real U.S. customer support. $100 bonus when you fund through the link below. Same market. Smarter structure. Raoul Pal's argument is surprisingly simple. While most investors obsess over timing tops and bottoms, he believes they're missing the much bigger story. In his view, Bitcoin isn't just another asset moving through cyclical boom and bust phases. Instead, it sits at the intersection of several powerful long-term trends: monetary debasement, digitalization, blockchain adoption, artificial intelligence, and the growing migration of value onto digital networks. If those trends continue, Pal argues that the long-term direction remains overwhelmingly higher, regardless of the volatility experienced along the way. What follows is perhaps the most controversial part of his thesis. After spending decades in financial markets, Pal says the biggest gains have often gone not to the most active traders, but to those who simply stayed invested. That leads directly into the next part of the conversation, where he explains why most traders ultimately underperform, why emotional decision-making becomes so costly during corrections, and why patience may be one of the most underrated investment skills in existence.
Look at how many traders there are, and look at how many of them actually made a lot of money consistently over time from trading. So people would say Paul Tudor Jones, Lewis Bacon, Stan Druckenmiller. Yeah, they also made a lot of money out of asset management fees. So that's where they made a huge amount of money after they got big. But yes, some of those guys, Lewis, Paul, and Stan, are all like 5 standard deviations talent. They just don't exist. Most people don't make money. Why is it that every brokerage firm, their most profitable customers, the people who make the most P&L are dead ones? The people who've made the most money out of crypto are the people who don't trade it.
Yeah.
You know, I've used the example of people like Wences Caceres or even Dan Moorhead. All of these guys have made a fortune by doing precisely all. And yet everybody wants to be the next trader who scalps it. And it's like, I don't get it. I just don't get it. And then it's all about emotion, and it's like angry when it goes down and like overjoyous when it goes up. And it's like, it's such a waste of energy.
You're saying doing all. Dan Tapiro would say you're being patient, which is very different.
It is.
It's actually like you did the thing, you bought the thing, and you're being, it's not that you need to reframe your mindset, which is, and I think it's Paul Tudor Jones who said, I want to make money in a trade or long-term trade by staying as long as possible, right? Which is the same thing.
Yes. And so go back to this universal code framework. Output of intelligence. The intelligence is the trade working out, compounding its capital, all of that. The units of energy. Just think of that. Think of the units of energy use of buying some Bitcoin and doing nothing. That is the most efficient trade you'll ever do in your life. But what we do is the inefficient, which is use vast amounts of our energy, mental energy, emotional energy, because we want to trade it. So what you're creating is a system that is, by definition, less optimal.
Why does more volatility make people think that crypto is easier to trade?
Well, because they're short-term time horizon people. So more volatility for people who are short-term. And there's people who can make a living from that. It's just very hard. Even Peter Brandt's like, it's a terrible way to make a living. You know, he's a long-term, been doing it for 40 odd years. It's not an easy way to make a living. None of the pit traders from Chicago really enjoyed it because it's hard to pay your bills by timing markets. And the emotional, it's not efficient use of your energy in the end versus in a secular bull market, just owning the asset. But yes, people can trade around it. And people may want to do it because it makes them feel good burning that energy doing that. They should just...
It makes them feel productive, probably.
Yeah, go and play with AI and just hold your Bitcoin. Do that. Use your productive energy somewhere else.
Yeah.
Because it's not the optimal outcome.
How can people develop patience and conviction when their portfolio is down 60 to 80% and stays down bad for a month, like we just had now?
Yeah, I don't even care. That's the thing. I don't care. I live off my salaries and income. And if I've got excess capital and it's oversold enough, I'm like, great, I could buy some more. Has my thesis changed? Is tomorrow going to be more digital than today? Yes, keep buying. If it's 2 standard deviations oversold, you should be, great, I can actually make more money in the future. But people don't see that. They think the opportunity cost is I've lost money now. I'm like, no, you can actually make more money in the future because you can compound and add money. People can't see this. And so it doesn't bother me. And, I've gone through all of these in the past, and I now know what to do, which is just buy the f***ing dip.
You f***ing idiot.
You f***ing idiot. Unless, all of a sudden you believe that crypto's never going to come back, it's never going to get used, which is just so improbable. So then just buy the f***ing dip, you idiot. And then again,
it's free money.
It's free money. It's people say, then people start buying the dip too early. I get it. It's not easy. Yeah. So the discipline is like 1 or 2 standard deviations oversold on the log trend. Do that. If not, do nothing. Just let the trend play out because it's noise in the middle. And if it goes wildly 2 standard deviations overbought, you have a massive bull run, sure, take some money off. Go and buy yourself something. If not, you don't need to do anything. You really have to have traded to really, you'd have to trade like 3 times every 5 years. That's with taking money off, or twice every 5 years just to add to your bet.
What makes Raoul Pal's perspective so compelling is that it challenges one of the strongest instincts investors have during market turbulence. When prices collapse, the natural reaction is to do something. Sell, rotate, hedge, chase the next opportunity. Yet Pal argues that this constant activity often creates the very underperformance investors are trying to avoid. His broader message isn't really about predicting the next weekly move in Bitcoin, or identifying the exact bottom of every correction. Instead, it's about understanding the larger forces driving the market. If the world continues becoming more digital, if blockchain networks continue expanding, and if monetary systems continue encouraging asset inflation over time, then the long-term investment case remains intact regardless of short-term volatility. That doesn't mean every project succeeds or that every correction should be ignored. But Powell believes investors often focus too heavily on temporary drawdowns while underestimating the power of long-term compounding. According to his framework, the biggest challenge isn't finding the perfect trade. It's developing the patience and conviction to stay invested when fear is highest and sentiment is at its worst. Whether you fully agree with Powell or not, his comments arrive at a fascinating moment for the market. Bitcoin has suffered one of its sharpest declines in months, Ethereum has fallen to levels few expected to revisit, and investor confidence has clearly been shaken. History shows that these periods of uncertainty often become defining moments that separate long-term investors from short-term speculators. If you enjoyed this analysis, please support the channel by liking this video, subscribing, sharing it with fellow investors. Also, be sure to check out our other videos covering Bitcoin, crypto markets, macroeconomics, and the latest insights from some of the biggest names in finance. Thank you so much for watching, and I'll see you in the next video.